My name is Jim Watson. I'm a licensed real estate instructor through the Department of State Division of Licensing Services. I teach for a number of schools in New York City and Long Island. Having said that, none of the contents of anything that we record here has anything to do with continuing education. This is a non-accredited program. You cannot get credits with the Department of State for having taken or listened to this video. So we're going to do today we're doing math. We'll do various math topics today. That I teach in the various schools that I teach in. And the content here will be directly associated with, more than likely, with the school tests that you're going to get from your real estate licensing school and state test issues also, because I get a lot of feedback from my students as to what they see on the state test. So we'll be covering probably 9 to 10 topics. And this should help you with the math on your school test for licensure to get your certificate, and also on the New York State test to pass the state test the first time. You may see appreciation problems on the school test and your state test. And the key thing about appreciation is that you have to take it 1 year at a time, because when things appreciate, they do it on an average annual compounded rate of return. So for instance, if values are going up 5% a year, and if we start out with the property valued at $100,000, and we go out 3 years, and it's 5% per year, we can't just assume that that's 15% over 3 years, because the numbers won't work. I mean, if we just we say, okay, 3% a year, 3 years at 5%, we're at $115,000. It's not going to work, and I'll show you why it's not going to work right now. We take $100,000 at the beginning of the first year, and we go out 5%, we're at $105,000. And that's the number that we have to use at the beginning of year 2. So year 2, we start at $105,000. We start here. And we have to increase that amount, and I'll do it as we're talking. We have to increase that amount by 5%. And that brings us to $110,250. And that's the number that we have to use at the beginning of year 3. So we come $110,250,000, and we increase that amount by an additional 5%. And we get $115,762.50. So, you know, you're not off by a lot at 115, but again, these are very small numbers that we're using. So appreciation has to be done year by year by year. We can't just take the number of years, multiply it by the rate of appreciation, and add that onto our original value. That will not work. We have to go year by year by year. That's how appreciation works. Unlike appreciation, if you get a depreciation question, and you'll get them in various formats, depreciation can be done in one step. So that if we have a $100,000 property that's depreciating by 3% over 5 years, you can do it in one step. 5 times 3% is 15%. 15% of $100,000 is $15,000. So the depreciated value at the end of 5 years would be $85,000. So again, appreciation has to be done step by step by step. Depreciation, because appreciation compounds upon itself, depreciation is a simple concept. We take the 5 years times the 3%. Our depreciated value is depreciated by $15,000. So $100,000 minus $15,000 gives us $85,000. That's one type of depreciation problem that you're likely to see. The other distinction you have to know is that properties are depreciated under IRS tax code over different numbers of years. Residential properties, anything 5 family or less, is depreciated over 27.5 years. Anything greater than 5 family is commercial, so a 6-family house or greater is commercial. That gets depreciated over 39 years. So let's do an example. If I buy a property, a residential property for, let's say, $500,000. The first thing my accountant's going to ask me is, what is the value of the land? So we have to get the value of the land. We cannot depreciate the land that a building sits on. We can depreciate the building itself. So you got to get a call. Jim, what's the value of the land? You just bought that $500,000 3, 4, 5 family house. Okay, I need to get an estimate of the value of the land, which I can probably do by pulling comparable sales off an MLS system or some website. Let's say the land is worth $50,000. The value of the building then is $450,000. And we said this is a 5-family or less property. So that's step number 1, take away the land. Step number 2, we bring the value of the building over here. And for depreciation purposes, since it's a residential property, we're going to divide it by 27.5 years. And I'm not going to do it exactly. We get about $15,000 per year. What's the value of that number? The value of that number is every year going forward for 27.5 years. Your accountant is going to reduce your gross income by $15,000 a year, every single year. It's like taking a photograph. It doesn't matter if the value of that building goes up or goes down or stays the same. They take like an old snapshot, like an old Polaroid picture, and that goes in your chart at your accountant's office, and they're going to take $15,000 a year off your taxable income. If you live in New York State, most of the state, we give up about 35% of our income to state and federal taxes. If you live in New York City, you're giving up about 40%. So, but let's just use a third, 35%. So if I can save 35% of $15,000 every year going forward, I'm saving in real dollars $5,000 every single year going forward for 27.5 years. That's on the residential side. If this were a building that had 6 units or more, this number would be 39, not 27.5. You would take the acquisition cost minus the land, gives me the value of the building. The value of the building divided by 39 years gives me this number over here. So in a mixed-use building where you might have commercial downstairs and residential upstairs, not only do you have different types of leases downstairs and upstairs, but your accountant's going to have to split the building up into pieces. The downstairs would be divided by 39 years because that's commercial space. The apartments upstairs would be divided by 27.5 years, and that would give you your numbers for tax purposes. Now, let's just go through the numbers again to make sure we're clear. Acquisition cost minus the land gives me the value of the building. We can depreciate the building, but not the land. We bring the building over here. For residential, we divide it by 27.5 years. For commercial, we would divide this by 39 years. Let's talk about cash-on-cash return. If my buddy John Sanchez were to lend me $5, and I were to give him back $6 tomorrow, that's an accurate way of representing what just happened. He just made 1/5 on his money, and the way you put this into your calculator would be 1 divided by 5. That's how you enter that information. That's how you read a fraction. 1 divided by 5. And what you'll have on your calculator is probably 0.2. To turn a decimal into a percentage, we have to move the decimal point over to the right 2 places. So we can add zeros here all day long, nothing changes. And then we move the decimal point over 2 places, equals 20%. That is the essence of a cash-on-cash problem. Money laid out of pocket goes on the bottom. Money returned to you goes on top. 1 divided by 5 equals 0.20 equals 20%. That's the cash-on-cash return. So if I were to tell you that somebody bought a building for, let's say, $500,000, and it cost them $100,000 to get into the property, let's say that's their down payment and closing costs, and they finance the rest. So they're financing $400,000. Let's stop there. There's only one number on the board that I care about. How much money was laid out of pocket? Just like Mr. Sanchez lending me $5, and I gave him back $6 tomorrow, so he made $1. So the only number that I care about on the board so far is the $100,000. On a cash-on-cash problem, we do not care how much the person paid for the property or the building. It doesn't matter. We don't care what they're financed. We're just trying to find our denominator. Our denominator is $100,000. So let's set up our fraction. Our denominator is $100,000. Let's say the building generates $15,000 a year in profit. And we do cash-on-cash annually, not monthly. So if you get a monthly number, be sure to multiply it by 12. But I'm going to tell you that this building generates $15,000 per year. 15,000 becomes our numerator. And we put that into our calculator, and this is what we get. 0.15. And what do we say? To convert a decimal to a percentage, we move the decimal point 2 places to the right, equals 15%. And that's our answer. So that's how we do cash on cash return. Let's just go through it again. Money made out of pocket goes on the bottom. That's our denominator. Money earned in the transaction goes on top. That is our numerator. 1 divided by 5 is 0.20, which is 20%. In this example, a building is purchased for $500,000, laying $100,000 out of pocket, financing $400,000. That's the only number that I care about. That becomes my denominator, and then the question would go on to tell you how much per year or per month. If it's per year, just put the number there. If it's cash generated per month, then you have to multiply it by 12. Okay? 15,000 over 100,000 equals 0.15 equals 15%. Let's talk about acreage. For some bizarre reason, the Department of State wants you to know how many square feet there are in an acre. It's virtually useless information to you. How big is an acre, first of all? I know people in New York City probably, if you grew up in the city, it's hard to find an acre that isn't built on. But if you take a look at either of the reflecting ponds at the World Trade Center, those are 200 feet by 200 feet, which is 40,000 square feet. A little bit shy of an acre, but when the buildings came down, they said we lost 110 acres and 110 acres of office space. Roughly true, not entirely true, but pretty close. Okay, so an acre really, 1 acre is 43,560 square feet. And I know some people have this little gimmick, 7-11. I suggest that you not use the 7-11 gimmick. 4 plus 3 equals 7, 5 plus 6 equals 11. Why do I suggest you not use it? Tutoring a student privately at the Huntington Public Library, I live in Huntington Village, comes out, and I ask her, how many square feet in an acre? And she says, 34,650. And I said, well, how do you know that? 3 plus 4 equals 7, and 5 plus 6 equals 11. But she got the numbers backwards as a result. So I would suggest do not use any gimmicks where real estate math is concerned. What you should do is just memorize 1 acre is 43,560 square feet. You could say, let's make up a mathematical problem. Let's say, for instance, if we had a square mile, this is a mile, times a mile. And if I would, I've always liked drawing things since I was a little kid. It just helps me to perceptualize, you know, what am I looking at? So a mile times a mile. How many acres are in a square mile? Well, I got to figure out first how many square feet are in the square mile. And if I can figure out how many square feet are in the square mile, I can divide it by the 43,560 square feet in 1 acre, and I'll get the number of acres. So let's see, now we have to, I'm taking you back to 3rd grade here. How many linear feet are there in a mile? And it always amazes me how few people remember. There are 5,280 linear feet in a mile. So 5,280 feet times 5,280 feet, that'll give me the number of square feet in a square mile. Okay? And it turns out that that number is 27,878,400 square feet. And by dividing 27,878,400 square feet by the number of square feet in 1 acre, I get the number of acres, which is 640 acres. That's how we handle acreage. So the 2 things you want to go into your school test and your state test absolutely knowing. How many square feet in an acre? 43,560. How many linear feet in a mile? 5,280 linear feet in a mile. If you were asked, how many acres are there in a square mile? For instance, just as a sample question, we had to convert a mile to 5,280 linear feet. And so we multiplied 5,280 times 5,280. That'll give us the number of square feet inside of a square mile. That turns out to be 27,878,400 square feet. We divide that by the number of square feet in 1 acre, and we get the number of acres, which is 640 acres. Let's talk about property assessment. You will be required at the salesperson's level to determine the assessed value of a property, probably on your school test and your state test. And the way we get the assessed value is we take the market value and we multiply it by the rate of assessment. So you could see a problem, a property has a market value of, to pick up a number, $200,000 of my market value. Assessments are done at 30%, period. Now that's where they end the sentence, but the full sentence would be, assessments are done at 30% of market value. But if they put of market value, the word of always tells you to multiply mathematically, so they'd basically be telling you how to solve the problem. So the problem is going to read, a property has a market value of $200,000. Assessments are done at 30%. What is the assessed value of the property? Clearly, 30% of 200,000 is 60,000. So this is my market value. 30% is my rate of assessment, which means this is my assessed valuation. At the salesperson's level, you'll be required to figure out the assessed value. When you take your broker's course, they're going to give you what's called a mill rate, and at that level, they're going to ask you to calculate what the taxes actually are. At the salesperson's level, you don't need to do that. So this is the actual assessed value of the property. Just to review, take the market value multiplied by the rate of assessment gives you the assessed value of the property. That's a problem that you're typically going to see on a school test and on the state test. Let's talk about capital gains treatment under the IRS tax code. As a result of the Tax Reduction Act of 1997, when Clinton was in the White House, whether or not you like the Clintons, I happen to be kind of fond of them, but whether or not you like them, this was dramatic. This changed to, as a single individual person, you could buy a property, had to be your owner-occupied residence, live in it for at least 2 years, and the first $250,000 of appreciation that you evidenced in the property would not be taxed when you sold that property. So let's say, for instance, somebody, a single person, pays $150,000 for a property. And they sell it a couple of years later. They hold it for some number of years. Maybe it's a fixer-upper, so they put a lot of sweat equity into it. And let's say they hold it for 5 or 6 years. They fix the thing up. And they're able to sell it, let's say, for $500,000. Their gain is $350,000. But the first $250,000 of the $350,000 is not going to be subject to capital gains taxation. So we go $350 minus $250,000. Only $100,000 is going to be subject to capital gains taxation. So just to review the numbers. They bought it for $150,000. They sell it more than 2 years later, having fixed it up, and it's up in value now. We're saying it's worth $500,000. That's what they sell it for after a 2-year hold as their owner-occupied residence. $500,000 minus $150,000 is $350,000 in gain, but the first $250,000 is free of capital gains taxation. Only $100,000 is going to be subject to capital gains taxation. Again, that's not the taxes. That's the amount that's going to be subject to capital gains taxation. Let's say this were a married couple. For a married couple, the capital gains tax incentive, and that's the kind of language you're going to see on the state test. A lot of the state test questions, the feedback I get from my students, tells me that the questions are written as if it was a CPA writing it, or a lawyer writing the question. So what is the capital gains tax incentive for a single person? We just said $250,000. What is the capital gains tax incentive for a married couple? $500,000, because there are 2 people. So the first $500,000 that the property increases in value, assuming it's a primary residence and at least a 2-year hold, the IRS tax code actually says they have to have lived there 2 of the past 5 years. But not to confuse you, at your level, salesperson's level, they lived there for 2 years. The value went up, say, $500,000. So let's make believe this is a married couple in the state of New York. They bought it for $150,000. They sell it for $500,000. Their gain is $350,000. How much of that is subject to capital gains taxation? None of it, because the first $500,000 that they earn would not be subject to capital gains taxation. This, again, is a result of the Tax Reduction Act of 1997. Let's talk about loss factor. You may see a loss factor question on the state test, on the school test. I'm going to keep the numbers simple, because if I keep the numbers simple, you'll understand the concept. And then no matter what numbers they put in front of you, it won't make a difference. One of the schools I teach here in the city, is rather large. We actually have a classroom that fits 125 people. I don't know what the actual square footage of the facility is, but let's keep the numbers simple. We have 4 classrooms there. Let's say that we have, and here's our formula, rentable square footage minus usable square footage is the loss factor. So let's say in a particular facility, we pay rent for 10,000 square feet. What's usable? I would say at that particular facility, the 4 classrooms. Let's say that those are 8,000 square feet, 8,000 square feet. So clearly, what's lost? What's wasted? What's not used for teaching? 2,000 square feet. I would include the hallways. I had a commercial guy in one of my classes. He says, Jim, you're not being specific enough. We got to measure that post. That's another 4 square feet that we lost. But for your purposes, rentable minus usable is the loss factor, okay? But in the answer key, you're never going to see square feet. The answer key is always going to be in percentages. And what they want you to do is draw a relationship between the loss factor and the total or the gross square footage. So if we use 2,000 as our numerator, 10,000 as our denominator, and again, how do I read that fraction? I read it this way. How do you put it into your calculator? 2,000 divided by 10,000 equals 0.2 or 0.20 equals 20%. And that's how you're going to see the loss factor. There's a flip side to the loss factor, and the flip side is, what is the building's efficiency? How much space is being used efficiently or effectively? Well, again, in that facility with 4 classrooms, we said the classrooms were 8,000 square feet. So let's draw a relationship between this and this. So we put 8,000 over 10,000. The building's efficiency is 80%. So just again, what do? Rentable square footage minus usable square footage is the loss factor. And we're keeping the numbers simple so you're able to understand the concept. 10,000 square feet minus 8,000 square feet is 2,000 square feet. We put the 2,000 over the gross square footage, we get 20% is the loss factor. We put the 8,000, which is the usable square feet, over the 10,000 gross square footage, and we get 0.80, which is 80%. Be very careful in particular when you take the state test. I mean, you have to be careful when you take your school test too, but the state test in particular, read the questions very slowly. Make sure that you're answering what they're asking you. You might see a loss factor problem, and you say, wow, the loss factor is 20%. It appears that option A is almost always going to be the most common wrong answer. So you look at A, B, C, D, A is 20%, bang, you got it right. You probably won't even look at that question again. But the trick is that they probably were asking what's the building's efficiency. So don't jump on that A answer at 20%. Look at the 4 options. Make sure you're answering what they're asking you. They could be asking you either what's the loss factor or what is the building's efficiency. We're going to talk about an investor formula, which you really need to write down or put in a notes section on your iPad or your mobile device. In the old days, you put it on a 3x5 card, you'd put it in your lapel, and you'd take it out once in a while and look at it. Here's the formula. This is the investor formula. It draws a relationship between the value of a property, the cap rate, or the intended rate of return of the investor, and the net operating income of the building, which is all of the income minus all of the expenses, gives me the NOI. So the formula is this. Value when multiplied by cap rate equals net operating income. So let's define them. The reason when you walk through New York City that there aren't, price tags on the buildings on the street is that we can clearly establish for a building what the net operating income is. We take the income for the building for the year minus the expenses of the building for the year. And that gives us our net operating income. But different investors have different cap rates, and that comes out of your head. What rate of return do you want to get on your invested capital? So if we lock this in place, then clearly there's going to be an interplay between this number and this number. If you have a very aggressive cap rate, like 10% versus mine, which might be 5%, and then you're going to have to make offers that are half as much as I'm willing to offer, because again, if we lock this in place, this is a number that we can establish. And the interplay then becomes between cap rate and value. Let's do an example. If I purchased a building for $600,000, for example, that's value, and I want to make a 10% rate of return on my invested capital, What's the net operating income for that building going to be? Well, now you're saying, Watson, I didn't need your stupid formula, because clearly 600,000 times 10% is $60,000. But it at least proves to you that my formula works. Value times cap rate equals net operating income. That's one example. Let's do a different example. Let's say, and here, now you're going to be glad you got the formula. Let's switch the numbers around a little bit, okay? Jim's looking at a building with a net operating income of $40,000 per year. He wants to make a rate of return on his invested capital of 10%, and you can tell me what the question is. How much should he pay for the building? That's the only piece that's missing. So, X. Now let's stop here for a second. Let's look at this. This is as difficult as real estate math is going to get through your salesperson's license and broker license, unless you go take a certificate course in real estate investment and finance, where you've got to have a Hewlett-Packard 12C. To me, things get really interesting at that point. But this is as difficult as real estate math is going to be for you. Solving for the unknown. You have two pieces. You're looking for the third part. I used to tell my students that for me was 1963, age 12, Grand Avenue Junior High School, walking in to start algebra. And we learned this in the first week. But then I had a third grade math teacher in my class, and she said, Jim, we're teaching this now in third grade. So if you have a 7-year-old in your family, they can teach you how to do this. And this is as difficult as real estate math is going to get. Let's review the language. We have to isolate the unknown. We do that by dividing both sides of the equation by whatever is sitting next to the unknown. On this side, that happens. Anything divided by itself is 1. 1 times Jim Watson is Jim Watson. 1 times this room is this room. 1 has no effect. It's a non-entity in an algebraic equation. And of course, you remember, whatever we do to one side of an equation, we have to do to the other side of the equation. And there's only one other thing. I'll ring your bells on some of the language that you heard. When you take a relatively large number and divide it by a really small number, you get a really big number. And so 40,000 divided by 0.10 is 400,000. So again, I want to buy a building with a net operating income of 40,000. My intended rate of return on my invested capital, which is the cap rate, is 10%. How much should I pay for the building? We isolate the X by dividing both sides of the equation by whatever's sitting next to the X. This disappears, and on this side, we're left with $400,000. I'm going to teach you how to qualify your customers in terms of mortgage qualification. It also applies to rentals. The question is this: how do you figure out what somebody can afford when they come into your office? And I'm going to set my bezel here. In less than 60 seconds, I'm going to teach you how to qualify a customer when they first come in. Here's what you do. You take their gross annual income, you divide it by 12, and that gives me the gross monthly income. There's only one more step. Take the gross monthly income. This is the old banking formula. I got involved in the mortgage banking business only less than a year after I got my real estate license. And I was in that business overlapping and overlaying my real estate business for 25 years. Gross monthly income times 28% is what people can afford per month. Now you can convert that 28% to 0.28. So gross annual income divided by 12 gives me my gross monthly income. Everything in the mortgage field is based on gross monthly income. That's where you have to get to. And then we apply this formula of multiplying the gross monthly income times 0.28 or 28%. That's what people can afford. In other words, if they apply 28% of what they gross every month in income to their housing expense, whether it's a rental or a purchase, they can still afford to have a car, send their kids to school, have nice clothes, buy insurance, go on an occasional vacation. Beyond that, we get into what we just lived through. Actually, I lived through it in the late 80s, and then again, 2006 on, which is a subprime meltdown, where people are extending themselves too far in terms of what they apply from their income to their housing expense. We can't assume all the time that values are going to keep going up, that incomes are going to go up, and that's what this whole boom, this whole bust was just recently based on. I'm going to start that over. We can't assume that property values are going to continue to go up, nor that people's incomes are going to start to go up. And as a result of applying too much of their gross monthly income to their housing expense, we just went through this major bust, the so-called subprime meltdown that we just went through between 2006 and 2011 or so. Things seem to be straightening up a bit now. But if we'd stuck to 28%, we would have been okay. That's how you financially qualify your customers. Now, you may see a test question on your school test or your state test, and I'm telling you 28% is the industry standard, but co-op boards here in New York City very often use 24%. They're a little more conservative. They only want you applying 24% of your gross monthly income to your housing expense. So whatever number you're given on a test question, whether it's 24, 25, 26, 27, 28%, use it. You don't want to sit there and say, no, Jim Watson said I should use 28%. Use the number that they gave you, okay? Now, here's where you can get tripped up on a mortgage qualification question. What if they give you the weekly income? Jim grosses $1,000 a week. How much do I make a month? Now, if the number $4,000 just went through your head, here's the mistake that you made. You took $1,000 a week, you're assuming 4 weeks in a month, 4 times 1,000 is 4,000. But the problem is that if you multiply 4 times 12 months, you get 48 weeks, and we all know that there are 52 weeks in a year. So you just lost 4 weeks of my income. So we have to put another step up here. Weekly income, weekly, times 52 weeks equals gross annual income. So if they give you the weekly income, multiply it by 52 weeks, which gives you gross annual income, then go to this step. Gross annual income divided by 12 is gross monthly income. Gross monthly income times 28% is what people can afford. That's how you financially qualify your customers. Why is it important? You're going to get customers who wake up on a Sunday morning, they come into your office, husband looks at the wife, wife looks at the husband. We can't afford it, but wouldn't it be fun to look at some $8,000 apartments today? And now they snag you, and you become their tour guide looking at $8,000 apartments, which they can't afford. So what do you do when they come in? Sit down with them, get them in a private room, a conference room, close the door. What was your annual income last year? Divide it by 12. I got this, multiply it by 0.28, and I've got what they can afford. If they can't afford what they want to look at, you probably have better things to do for the day. That's how we financially qualify our customers. I only know of one other person in the city of New York who even teaches this to salespeople, but this is golden information for you, so you don't spend a lot of time showing people things that they can't afford. Let's talk about a net to seller problem. Very often a seller will say to you, and here's how it's going to sound. What am I getting out of this? Which means they want you to start with where we listed, where do you think we'll sell the property? And then account for all of the expenses. It's called a seller's net proceeds sheet, where you start with the sales price, and they've got to pay the broker's fee, they've got to pay their attorney. They have New York State transfer tax. If it's in New York City, we got New York City transfer tax. So start with the sales price. What do we think we're selling it for? Take out all of those expenses, and what is the seller left with? But sometimes they'll state it differently. It'll get stated, Jim, I want to net X number of dollars on the sale. And if I want to net that, what do we have to sell the property for in order to have me walk out of the closing with a check of that amount? Again, I'm going to use the numbers, the simple numbers, so that the concept is clear. These will not be the numbers that you'll see on the state test in particular. They use different numbers. But let me teach it to you this way, because it'll become eminently clear to you why I'm using these numbers in about 30 seconds. And every net to seller problem sounds exactly the same way. Just to put this in here, you've probably noticed in the course of this video that I have labeled every single math problem. If we label it, give it a name. What is it? Like net to seller. If we establish how to do it, and if we do it the same way every single time, then we're going to get the right answer every single time. Okay? So here's how you set up a net to seller. The problem will read like this, with different numbers. A seller wants to net $100,000 after paying a broker's fee of 6%. And the question will be, what does the property have to sell for so that those two events happen? The seller walks out of the closing with a $100,000 check. The broker walks out with a fee that represents 6% of the sales price. And the question is this, what's the sales price got to be? And I'm going to suggest that you set up the problem this way. I even suggest you put it in what I call the setup box. Create a box. Because if you do this, if you follow my steps, and you probably noticed if you know me or you've watched my videos that I give pretty good advice, okay? If you follow my steps, you should get this right every single time, like we said. Now, will you agree with me that the sales price equals 100% of the transaction? In other words, if I were to sell my house for, pick a number, $800,000. That's the number that I put at the top of the sheet. And then all of my other numbers derive from that $800,000 sales price. So the sales price is 100% of your transaction. That's the number we start with. So when you do your numbers in the setup box, I want you to put equals 100%. This will remind you to do the following. If the sales price is 100% and the broker is walking out of the room with 6%, what percent is the seller netting? And clearly, 94%. 100% minus 6%, the seller is going to get 94% of the sales price. And of always tells you to multiply, doesn't it? Mathematically, the word of says multiply those two numbers. So the seller is going to get 94% of the sales price. So if you look at this number on the board, this is the net to the seller. But I still can't solve for the sales price unless I set up an equation. That's going to be easy. Let's make an equation. Equals net to seller equals net to seller. What number goes on the right-hand side? You've got it. It's in the setup box. That's the $100,000. So net to seller equals net to the seller. Let's put $100,000 over here. And we're back to third grade math, aren't we? You're going to see this over and over and over again. How do we solve for the sales price? I'll review the language with you. We divide both sides of this equation by whatever is sitting next to the unknown. And what happens on this side? This disappears. What happens over here? We're going to get an answer. 106, $382.97. That's my sales price. Now, if when I put the numbers on the board, and again, I told you you'd see in 30 seconds why I use these numbers. When I put the numbers on and you first looked at them, you probably thought $106,000 would do it, because you would say, well, I'll just take 6% of $100,000 and add it to it. The reason that doesn't work is the 6% is a function of this, which is the unknown. The 6% is not a function of this. So here's the problem. You list my house, I say I want it at $100,000, you sell it for $106, you come to the closing, your broker, I'll do that again. Stop throwing stuff around the room. Here's the problem. You sell my house for $106,000, and then your broker or your office manager takes 6% of $106,000 and comes up with $63.82, and that's what your commission bill is going to say. Got bad news for you. I'm not paying you that extra $382, and it's probably going to come out of your portion of the commission when your broker writes out your check. Not a big deal, it's only $382. But this is only a $100,000 sale. Let's make this, on the assumption that a lot of people in New York City are watching this, let's make this an entry-level condo in New York City, $1 million, okay? Add a zero. Now your commission is off by $3,820. One of my students, Stephen, very graciously gave us his penthouse waterfront condominium in Cape May, New Jersey. And Karen and I went down, beautifully decorated. He named it after his mother, smart guy. Name something after your mother, good things are going to happen to you. And we're down there. He calls me 2 weeks out of our classroom at one of my schools. He made his first sale, $9.5 million in the Dakota. You make that mistake on a $10 million property, your commission is off by $38,000. One of my friends just picked up a $96 million listing here in New York City. You make this mistake on a $100 million listing, your commission is off by $382,000. I think that would buy you a Bentley GT Continental convertible. Okay? So you want to know how to do this. So as long as you understand the steps, we set up the numbers in the box, again, just to review, and they all sound alike. They sound the same way. The seller wants to net $100,000 after paying a broker's fee of 6%. What does the property have to sell for? That's the question. And remember to put equals 100% right here. This minus this gives you this. So if this is 5%, this is 0.95. If this is 7%, this is 0.93. If this is 8%, this is 0.92. This times the sales price equals whatever that number is. And then divide both sides, just simple algebra, and you're going to get what the sales price has to be. Fairly basic. Okay, just remember, you cannot add 6% of the net onto the net to get the gross. You have to go through this step and this step, but there are only 2 steps, and you'll do every one exactly the same way. You might be asked to figure out the area inside of a geometrical shape on your school test or state test. It's not going to be real complicated. First of all, they're not going to give you like anything three-dimensional. I haven't seen any cubic foot or cubic yard questions any place. Not on the school test, not on the state test, to the best of my knowledge. So we're looking at, flat two-dimensional shapes, okay? So, you might get something that looks like this. And let's make up the numbers. Let's say this is 20 feet. Let's say this is 10 feet. Let's say this is 18 feet. 18 feet. So those are our dimensions. I would suggest that, again, this is a right angle. My drawings are not the best, but that's a right angle, okay? Which means a 90-degree angle. I would suggest that you split it up into different shapes that you can recognize, okay? The truth is this one, the truth about this one is you can actually average the top and bottom dimensions and get the average of those two, multiply it by this and get the area. But that might be a little beyond you. So let's do this. Let's make it simpler. Let's split this up into two shapes. Again, this is a 90-degree or a right angle right there. Now, if this is 10 feet, and if these are parallel, and we're assuming that they are, my drawing isn't as nice as it's going to be on the state test or school test, but it is what it is. 10 feet, this will be 10 feet over here, okay? If this is 20 feet across here, and that's 18 feet, then this is 18 feet, which means this is 2 feet right here. Now the question is, how do we get the area of a rectangle? So let's just deal with this at first. Length times width. 10 feet times 18 feet. This is 180 square feet. Now, what's the area, what's the formula for the area of a triangle? And I know I'm taking you back to 9th or 10th grade, but the formula is, and just accept it for now. There is a proof, and when I was in 9th grade, I loved the proofs. You went through the various steps to prove that the formula worked no matter what type of triangle it looked like. But for now, we're just going to do this. Base times height divided by 2. Just accept the fact for now, unless you want to get an algebra book and go through the proof, which is actually fun, but you probably don't need to. Base times height divided by 2 equals 2 feet by 10 feet is 20 square feet. Divided by 2 is 10 square feet. And then what do? You add them together. 180 square feet plus 10 square feet is 190 square feet. You add them together. Let's go through it again. If you see a shape something like this, you want to divide it up into various shapes, okay? I made up the dimensions. This is 20 feet here. This is 10. We've got 18 feet across there. So do the simple one first. Just do the rectangle. 10 times 18 is 180 square feet. We said that the formula for a triangle is the base times the height divided by 2. The base is 2 feet. The height is 10 feet. That's 20 square feet divided by 2 is 10 square feet. And then don't forget to add them together. 180 square feet times plus 10 square feet. I'm going to do it again. Don't forget to add them together. 180 square feet plus 10 square feet. The answer to this one in particular is 190 square feet. That's about as complicated as you'll see. I haven't seen any circles. You remember pi r squared? I haven't seen any circles. Basically, rectangle and triangle is as complicated at the salesperson's level as I would expect it to get for you. So now we'll review what we covered today. We talked first about appreciation. My business partner, John Sanchez, is here helping me. We'll turn those pages, John, if you would go to the next page. Thank you. And we said appreciation, we have to do step by step by step. So if we start out with a $100,000 property, over 3 years, it's going up 5% per year. We can't just do 3 times 5 is 15% and get to $115,000. We have to do each year individual. Then we start with $100,000. At the end of 1 year, it's worth $105. We start with $105. At the end of that second year, it's worth $110,250. We start with that for our third year, and we get to $150,762.50. So we can see clearly just multiplying this times this and adding that amount just simply does not work, okay? So that was appreciation. Then we talked about depreciation. And we said that this is a simple mathematical concept. With depreciation doesn't compound. Appreciation compounds upon itself. Depreciation does not. So we have a $100,000 property. It's being depreciated for tax purposes at 3% over 5 years. We multiply the 3 times 5, we get 15%, and we take away 15% from 100,000. The depreciated value at the end of 5 years at 3% is $85,000. Now, you may see depreciation in a different way. You may see a property is purchased for $500,000. Over how many years may it be depreciated? And it depends on whether it's commercial or residential. So here, $500,000, we have to take away the value of the land, which is $50,000. We get down to $450,000, which is the value of the building. Land is not a depreciable asset. The building is. We cannot depreciate dirt. Okay? So this minus this gives us this. Step number 2. This, and we said this was a 4 or 5 family property, so it's residential. $450,000 divided by 27.5 is approximately $15,000 a year. And what's the significance of that number? That's going to come off of your gross income each year going forward for 27 and a half years. So the net result, when I do my investment classes, we'll talk about this more, but the net result is not only did you buy a $500,000 property that probably has cash flow, probably is going to go up in value, but you're depreciating it for tax purposes. You bought yourself the right to make $450,000 in regular income over the next 27.5 years, free of any taxes whatsoever. So I didn't know about this stuff when I started, but you get the building, you get the cash flow, you get the appreciation, you get the depreciation. This stuff is magical. It's great stuff. If that were a commercial building, it would be over 39 years, not 27.5. Then we talked about cash-on-cash return, and I used the example of Mr. Sanchez lending me $5, and I see him tomorrow, and I give him $6, so he made $1. And we established that 1/5 was what he made on his money. This is the essence of a cash-on-cash problem. Money out of pocket on the bottom, money coming back to you on top. How do you read that fraction? 1 divided by 5. Put that in your calculator. It's going to say 0.20, which is 20%. Another example would be I buy a building for $500,000, I put down $100,000, I finance $400,000, and the building generates $15,000 a year. What's my cash-on-cash return? Of these 3 numbers, the only one I care about is this. That becomes my denominator. My numerator is how much I make per year, equals 0.15, equals 15%. We talked about acreage. For some reason, the Department of State thinks it's important for you to know that there are 43,560 square feet in an acre. I can't imagine why, but you need to know that. Okay, so memorize this. 1 acre is 43,560 square feet. And you might see a question, how many acres are there in a square mile? Well, we want to convert a mile to 5,280 feet, linear feet. You walk 5,280 linear feet, you get a mile. We multiply 5,280 times 5,280. And we get 27,878,400 square feet. If I divide that by the number of square feet in 1 acre, I get the number of acres. So how many acres are there in a square mile? 640 acres in a square mile. And how do we get the assessed value of a property? We take the market value times the rate of assessment equals the assessed value. So if you see a question, and they're all going to sound the same. A property has a market value of $200,000. Assessments are done at 30%, and again, that's where they stop the sentence. Because as they say, assessments are done at 30% of market value, they're telling you to multiply the 2 numbers together. So they always cut the sentence short. Assessments are done at 30%. What is the assessed value of the property? $200,000 times 30% is $60,000. We talked about the treatment of capital gains on your primary residence, essentially. And we said that as a result of the Tax Reduction Act of 1997, as an individual, the first $250,000 you make in capital gains on the purchase and sale of your primary residence, having held it for 2 years, is $250,000. What is the capital gains tax incentive for a single person? $250,000. What is the capital gains tax incentive for a married couple? $500,000. So if a single person bought this, actually we use, single person, $500,000 acquisition cost, but they paid $150,000 for it. They made $350,000 in capital gains, but the first $250,000 is free of capital gains taxation, so they're only going to pay capital gains taxes on $100,000. Okay? If this were a couple, $500,000 is their sales price. They bought it for $150,000. They made $350,000. And we know that the first $500,000 is free of capital gains taxes, so they wouldn't be paying any capital gains taxes on that $350,000 whatsoever. We talked about loss factor, and we kept the numbers very simple so that the concept is simple for you. Rentable minus usable space equals the loss factor. What do we pay rent on? And we made some assumptions. let's say it's 10,000 square feet is what we pay rent for. Let's say that the classrooms, 1, 2, 3, 4, classrooms, A, B, C, D, whatever, is 8,000 square feet. 2,000 square feet is the loss factor. But square foot is never going to be in your answer key. What's going to be in your answer key is percentages. This over this is the loss factor. So 2,000 over 10,000 is the loss factor. 0.20 is 20%. The flip side of that is what is the building's efficiency. That would be the 4 classrooms in one facility I teach at. 8,000 over 10,000 equals 0.80, which is 80%. And I want you to be very careful on the state test in particular. It may look like a loss factor question, but you have to read it slowly. Read it carefully, because they might be asking you what the building's efficiency is. And very often, the first answer, which is A, will be the most common wrong answer. So you'll see 20%, you'll jump on it, say, I got that right, and you won't even look at it when you go back. But read the question carefully. We talked about a cap rate problem. Any problem you see with cap rates in there or net operating income, the first thing you do is look away from the question and write down the formula. Value times cap rate equals net operating income, okay? And so let's say in one case, we picked a property. A property is purchased for $600,000. The rate of return on invested capital is 10%. That building is providing a net operating income of $60,000. Okay? We reversed the numbers. We switched them around. We said, what if Jim wants to buy a building with a net operating income of $40,000? He wants to make a 10% rate of return on his invested capital. Obviously, the question is, what should I pay for the building? And again, this is third grade math. We reviewed that, okay? How do we solve for the unknown? We have to isolate this x. We isolate it by dividing both sides of the equation by what's sitting next to the unknown. 0.10, 0.10. On this side, anything divided by itself is 1, which is a non-entity in an algebraic equation. 40,000 divided by 0.10 gives us our answer, $400,000. How would you check it? 400,000 times 10% is $40,000. I told you that I would teach you how to qualify your customers in terms of what they could afford a month, either in terms of a rental payment or a mortgage payment. And it's the same no matter what. You take the gross annual income, divide it by 12, you get the gross monthly income. You take the gross monthly income and multiply it by 28% or 0.28, you get what they can afford. That is the industry standard since I got into the mortgage business in 1983. Where you could get messed up on a state or a school question is if they give you the weekly income. If I make $1,000 a week, you might jump to the assumption I make $4,000 a month. The problem is if you assume 4 weeks in a month times 12 months, you got 48 weeks, and you just lost 4 weeks of my income. If they give you the weekly income, we have to intersperse a new step right here. Weekly times 52 is gross annual income. Gross annual income divided by 12 is gross monthly income. Gross monthly income times 28%, which is the industry standard, is what they can afford. If they give you 26% or 27% or 25%, use whatever they give you in the question, but this is the industry standard when you're working with customers in the real world. Sellers will say, what am I getting out of this? What do I want to net? Or they might say, I want to net this much money. And I use simple numbers here so you could see where you could make a mistake. Seller wants to net $100,000. I call this my setup box, by the way. Put these numbers in exactly like this. After paying a fee to the broker of 6%, what does this property have to sell for? That's my question. And immediately after that, I want you to put 100% because my sales price is 100% of my transaction. 100% minus 6% gives me 94%. 94% of, which means to multiply the sales price, equals that number. Set up that equation. Divide both sides by 0.94, and in this particular case, and some of you might have thought when you first looked at it, the answer would be $106,000. But the answer is actually $106,382.97. You have to go through the 2-step. Step 1, set up the numbers in the box. Step 2, set up your equation, solve for the sales price. You'll get it right every single time. You may see some geometrical shapes on your school test or your state test. They're not going to be really complicated. You're not going to get anything volume like length times width times height. You're not going to see pi r squared like for a circular pipe or something like that. You're not going to see it, okay? So, but you could see is a combination of, say, a rectangle and a triangle. So I'm making up the numbers here. If you saw a shape like that, let's say it's 20 feet from here to here. It's 10 feet here. It's 18 feet here. And the question is going to be, what's the area inside of that geometrical shape? Well, let's do the simple one first. We'll do the rectangle. Length times width. 10 times 18 feet is 180 square feet. We said that the formula for the area of a triangle is base times height divided by 2. Base is 2 feet. Height is 10 feet. That's 20 square feet. Divided by 2 is 10 square feet. And now we add them together. 180 plus 10 square feet, the answer is 190 square feet in this particular instance.